Hello, everyone, and welcome to today's Savvy Investor webinar in partnership with State Street on growth in the asset management industry. I'm James Redgrave, Vice President of Thought Leadership and Editorial at State Street, and I'm joined by an expert panel to discuss a variety of topics relevant to this subject, including expansion into new geographic markets, into new asset classes and product structures, and new investor types and distribution channels. Before I ask my panel to introduce themselves, just a few housekeeping points. Firstly, you should see various engagement tools on your screen. They're resizable and movable and customizable, so please feel free to make your screen customizable to yourself. If you're joining today on a small laptop or a smaller screen like a phone, you may not be able to see everything in your current point of zoom, so make sure you're zoomed out so you can see all the functionality. We have a resource section with some interesting resources in it, so feel free to click on that and have a look at what we have. And if you have any questions, please feel free to use the Q&A box. Anything we don't get around to answering today, we will follow up an email, so please do ask. And lastly, if you're having any trouble with your video or audio timings or any other issue of technology, you can refresh using the F5 key. You can ask questions in the Q&A, and there's an FAQ box at the top as well. So all that said, I'd like to introduce my panel or ask them to introduce themselves. George, let's start with you.
Yeah, hello, George Barburis. I'm Executive Director, Head of Research at K2 Asset Management, currently overseeing investments across all asset classes, all parts of the capital structure across K2 and other associated fund management firms, and a background in funds management in around 28 years now with some major global players, again, managing investments, investment teams, and risk across both developed and emerging markets.
Thank you very much. Ruby.
Thanks, James. Ruby Paramanathan. I'm a director in KPMG's asset management practice. I lead the distribution and digital client experience part of the practice in the UK. I'm also co-leading a piece on innovation in asset management, so starting to look at the role of technology and other disruptive factors when we look ahead into asset management and how that's going to shape the industry.
Excellent, thank you. And Neil.
Well, thank you. Good afternoon, James, and welcome to my fellow panelists. My name is Neil MacDonald. I'm the Senior Vice President and Head of the APAC Asset Managers segment for State Street. I've been with the organisation for the past year, but I've spent 30 plus years in financial services, the last 20 of which were in asset management. So I've had the very good fortune to work for the likes of Barclays Global Investors, BlackRock, and JP Morgan Asset Management. My role at State Street really has two dimensions. One is to ensure that I bring the best of State Street to our current client base, i.e. all those asset managers we service across Asia, and also to listen to those asset managers and ensure that we are taking on board their comments and moving ahead in terms of service and product innovation. So if there's a gap in what we do and how we do it, my job is to listen and to come back and be the client's advocate inside of State Street. So like I said, I've had the good fortune to work for a great number of asset managers, and I now have a great number of asset managers as clients. And so I'm really delighted to be here today and very much looking forward to what George and Ruby have to say about the state of the industry today and what it might be like tomorrow.
That's excellent. Well, thank you all for joining me. I really appreciate your time. So let's dive in with some questions. Let's start with talking about the geographic expansion issue. And George, we'll start with you if that's okay. Which new geographic markets do you see as key to distribution growth for the asset management industry in general in the next, say, 3 to 5 years?
Yep, a lot of time and effort goes into that. I'll overgeneralize it, but Southeast Asia is a very big area. We are deep in discussions within the region, basically surrounding Singapore, particularly non-listed assets in that part of the world. And another geographical region outside of Southeast Asia and the APAC region, obviously Australia, New Zealand, that we're engaged with more actively is the MENA region, in particular the Middle East, which is quite unique in that it's obviously transitioning from the petrodollar to be a massive savings hub for the decades ahead, and at the same time it's got this very unique competition within that hub, different characteristics between Qatar, Oman, UAE and Saudi, for example, and they're all in that transition phase and using technology at a rapid pace, just like Southeast Asia, and looking at innovation as well. And on the back of those two regions, we're heavily engaged again in that non-listed space and some other areas at the moment. So we see lots of growth continuing from there.
That's interesting. Ruby, does that tally with your experience?
Yeah, absolutely. I mean, inevitably, I knew Asia would come up, and I think George and Neil are very well placed to cover those offers as regions and what growth we're going to see there. If I look at the rest of the world, obviously, if you've been following the UK market, we've been going through an interesting time at the moment. I would say in UK and Europe, I'd expect, if we looked at last year, it grown to about over 30 trillion euro assets. So I think that trend in Europe of slow, steady state growth, I expect that to continue to happen. Are there going to be new markets? I think it's going to be penetration into the sort of leading markets continuing. So aside from the UK, France, Germany, Switzerland, Netherlands, Italy, and it's going to be more about looking at the distribution channels and the product types and sort of access into the retail market. Where at the moment, I guess there's probably a rough split of investment into mutual funds versus discretionary mandates. I'd expect that proportion to start to slowly tip further into discretionary mandates, particularly if there is more movement towards things like giving access to private assets into the democratization of private assets into the retail market, and also the ability to offer that sort of mass portfolio customization. If you look at the positioning in the US, so some of the global asset managers are sort of looking to strengthen or penetrate into the US much further, whether that's through the kind of ETF trend and growth of ETFs there, or in fact through a wealth and advisory type acquisition or buyout, and starting to strengthen and capture where they've got institutional footprint go into that retail spectrum. So I think also there's likely to then be a testing of the waters, if you like, to see how much traction of ETFs is going to come back into Europe and the UK.
That's really interesting, thank you. And I look forward to going more deeply into some of those product and distribution channel trends as well. Neil, do you have anything to add?
Yeah, I think to both George and Ruby's point, I think the question about where the growth will come from depends on where you're looking at it from. So if you're looking at it from, I guess, from the East and from Asia, then you are going to be looking at Europe and you may be looking at the US. If you are looking, I guess, from the West, then China dominates. I would say most of the clients I speak to, China and becoming successful in the Chinese marketplace is a top 5 strategic priority for the vast majority of them. I think that's an incredibly complex journey for many, for those that choose to take that road. But undoubtedly, I think the size, the growth rate, and the continued expansion of that marketplace makes it extraordinarily attractive to many asset managers. I think you're also going to see a south to north. So I'm really interested in George's view on this. But I think when I talk to my Australian clients, I think that the Australian asset managers are going to be in expansionary mode for quite some time to come too. When I think about some of the clients and some of the deals that you've recently seen, I think Australian asset managers will be pretty acquisitive in the coming years, and you'll see Australian footprints crop up in Europe and in North America.
Interesting. George, do you have a response to that?
Yeah, I totally agree. Number 2 economy in the world, China's been a big important part of asset management, getting funds from there, developing funds across the asset classes or parts of the capital structure. And that's been developing in different ways for a good 15 years for the firms I've been involved with and their global footprint in Australia at the time, and even the domestic ones. But there's a slight pivot and adjustment going on since March 21. China's obviously had a change in regulatory oversight, and basically the cut to the chase after the end of this month for the 5-year party Congress, there'll be more certainty at the bureaucratic level with ministers and bureaucrats across the board for that 5-year plan, which is required to complement the PBOC with their policies and to deal with the what is undoubtedly a big property bubble that they have to address. But China is important, but what has happened from the growth of China over the past 25 years is that there's been benefits in specifically Vietnam, Thailand, Malaysia, and most importantly, Indonesia. Indonesia uniquely has got the fixed capital investment for their economy at the same time as having a commodity export base as a good cushion. So it becomes a commodity currency similar to what Australia, Canada, South Africa traditionally been in Norway. You can add, in essence, Indonesia. So it's got developments right across the board, and it's performing quite well in the emerging market. And we're seeing a lot of interest from pension to family offices via Singapore MAS license that are reaching out to fund managers globally and to Australia. And we're one of those to help develop specifically, again, traditional asset classes, but increasingly the non-listed asset classes. Also, I can sort of see a North America tie and UK tie. We're trying to do more with the UK, but there's nothing there at the moment as we're trying to develop. But we are, again, Southeast Asia's big growth. We've got a lot of Chinese clients and FUM, but from the growth rate, it's Southeast Asia, again, via Singapore MAS license registration there, HKMA, MAS, and ASIC as the regulators in the region here pretty much are aligned. And then the MENA region, we're struggling to catch up with the amount of demand and requests coming from that savings pool. And the unique thing I'll repeat here is that there's competition within that hub, unlike China, where it's just one large hub of 12 to 13 provinces. You know, that there is unique competition for innovation, technology, the digital development, infrastructure for Qatar, Oman, UAE, and Saudi that I flag, that they're all moving in the same direction, but with a healthy competition. And we see a lot of growth from there as well, just to reinforce that point.
Interesting. Ruby, picking up on Neil's point before about Australian asset managers sort of expanding outwards, from your perspective in the UK and Europe, where is the sort of bulk of inward expansion from outside in terms of asset management distribution coming from, do you think?
Yeah, I think we are seeing some interest from Australia and Asia, I would say, coming into the UK. I think we can't ignore sort of the recent events as well in terms of, I guess, general consensus around financial stability, what happened in the gilt market over the last sort of week or so, cost of living crisis. We've got energy crisis hitting the UK and Europe, which is now making that kind of shift into renewables investing kind of a real stark reality. So I think it'll be interesting to see whether any of that affects any intentions to come into the UK. But I'd say prior to that, there was certainly an interest of sort of coming into the UK. And actually, there's been a lot of work across the City of London, the government, etc., around what can we do as a UK economy to attract overseas flows? What do we need to do from a policy perspective, tax perspective, etc.? So all of those moves are happening. I think we'll just need to keep a watching eye on whether that traction really takes effect over the coming year, depending on sort of where the market goes. I'd say those asset managers that are coming into the sort of UK market, the biggest play is around the wealth and sort of retail arena. And where can you start to, you know, offer a more diversified asset class or global investment, particularly where, you know, that portion of the market is looking at the rest of the world and looking at where are the growth companies to invest in, where can we look at creation of long-term wealth.
Interesting. And yeah, before we move on from this geographic expansion question, I think the point you raised there about sort of financial stability in the UK is interesting and brings up a broader question about the sort of future of asset management distribution in perhaps a more geopolitically polarized world. Any of you sort of within the industry that we're maybe heading into a world where moving across borders in terms of transferring business and assets will potentially be harder due to sort of tensions between power blocks and nations? And is that something that's sort of on the mind of the industry? Neil, perhaps you start with that.
You know, I think, are we living in a world of enhanced geopolitical risk? Absolutely. Do I think that many of the clients that I talk to, senior asset management executives, see through much of that? Yeah, I think that they see through it all, and they have long-term plans, right? So I think that there is undoubtedly, I think to George's point, many eyes will be focused on the Chinese Party Congress meeting in the next week or so, and with hopefully the outcome of that some certainty in terms of direction of travel for the Chinese economy, at least over the next 5, maybe even 25 years. That will, I think, take some noise out of the system. I hope, and I hope reduce the tension that we're currently seeing. But if I think about China as an example, the clients that have and asset managers that have already declared an intention to take out a retail fund license, is it taking them longer? Yes. Are they still very much focused on the size of the prize in China? Yes. And so I think about, George's point about Southeast Asia and MENA. From a kind of raw asset management market sizing point, Indonesia looks very small and dominated by local players right now. But it's the 6th most populous nation on earth and is becoming increasingly wealthy at an increasing rate. And therefore, will it be an attractive place for an asset manager to have great product? Absolutely. And I guess the question is, George, really, over what time period does that become a genuinely attractive opportunity to many folks in the region?
Yeah, so very specifically, Indonesia has elevated itself at a very fast rate in the past 3 years. And again, it's had many opportunities to be this economy. But this is the first time in the business cycle is not dead. It exists, even though the Fed's raising rates and the PBOC is cutting rates and everyone's in the middle somewhere. But the resilience of the Indonesian economy when emerging markets are under more severe stress at this stage of the cycle. There's emerging markets in parts of North Africa and Central America, South America, that has some stresses in there because emerging markets are so diverse. But specifically, Indonesia is showing that it's performing quite well. And again, it's that enhancement of sustainable resource exporting. They're a key part, like Australia is, South Africa, Canada, to the energy transition of the decades ahead. They have the key metals and resources required. So there's good long-term benefits there. The population base is good for domestic demand. There's lots of capital controls in the asset management industry. It's very difficult. You're unable to launch an asset management firm within Indonesia. But specifically, the demand and growth for Indonesian entities with an MAS license that have positioned themselves to de-risk, because effectively that's what the Malaysians do as well. Once you have a MAS license like a HKMA and ASIC in Australia, you illustrate good, safe custody globally, no matter where you are, and obviously hence our relationship with State Street. Once you solve for safe custody across all asset classes, then you can take them anywhere in the world. And that the play that we have seen in a very short few years is large Indonesian firms relocating into Singapore, investing in North America specifically, non-listed, in Europe, looking at the UK and Australia at the same time. And we're engaged in that process right now at the moment.
Excellent. Ruby, you mentioned before a trend towards asset managers expanding the range of product types and structures that they offer. Could you perhaps give us a little bit more detail about what's sort of driving that trend and what the impetus behind it is?
Sure. So there's quite a lot happening in the product space, particularly from the UK, Europe perspective. I'd say that spectrum of products where previously you had products that are retail-esque and products that are more institutional-esque, those lines are very much starting to blur. And that's fundamentally the principle and trend that's driving a lot of what we're seeing from a product perspective. Some of the things I touched on before, so the ETF market, I think active managers are still, looking at, okay, what's the role that active ETFs can play in that market, where in the US, you've got that sort of trend of the passives taking over. I think we'll probably expect to see that shift from ETFs from active to passive, and probably smart beta, growth ETFs, ESG ETFs. So the, I guess, labels around the ETF products, I think we're going to see expanding. And then you start to see a blurring of line between the active ETF and what mutual fund is offering. I talked about ESG. I think of all of the globe, I think UK and Europe, the ESG trend is phenomenally strong. And I mentioned the energy crisis that is starting to make the reality of investing in ESG, what the impact of that really means. So we're seeing asset managers starting to think about how do you articulate and quantify the impact of investing, the impact of your engagement, the impact of your stewardship, and sort of how you articulate that and the transparency of that into the sort of retail channel. I think if we look at the sort of the two key trends that I'm seeing are one around the private assets and the democratization of private assets. And where we're seeing that manifest, we've got the LTIF structure, which I think still has some way to go in terms of the European regulations, looking at whether you can lower the minimum threshold there. But we're starting to see asset managers launch the LTIF structure into Europe, which is starting that trend of private assets and liquid strategies into the retail market. You then have the sort of retail-esque platforms that are looking to democratize the private assets. And then if we go into the sort of tokenization and blockchain regime, which I know we're going to come on to later, in the UK, the IA, I think last week, said they expect tokenized funds to be launched within the sort of next 12 months. You look at Asia and in Singapore, investors are already able to sort of purchase tokens, given the sort of the ability and capability there. And out of the US, you've got this lead of, because of the change of rules in pension schemes allowing you to allocate assets to private equity, they're very much driving hard the sort of private asset split. So I think all of those things, and then we haven't even come into crypto, metaverse funds, all of the kind of great new products that are being created that initially were very sort of institutionals naturally hedging their bets or investing in those types of assets. We're now actually seeing more of a take up into the retail market. And I saw there was a survey that into the retail market that actually where retail investors were saying, you know, the stock market and the bond market is actually more arcane than the crypto market. So this notion that crypto is this mysterious asset isn't actually what the market and the clients are telling us. So I think all of those factors, it's a very much demand led, and whether you believe crypto is the right thing or the right thing to be investing in, you can't ignore what the demand is telling you, particularly from a retail end of the spectrum.
That's an interesting answer. Thank you very much. George, would you like to pick up on this?
Yeah, I can pick up a few themes there, but very quickly on the digital, we've been fortunate to work with State Street and a few other key bodies in North America to launch Australia's first Bitcoin and Ethereum ETF. So that took a long process, but the stepping stones for that was Australia is one of 5 countries, Australia, Singapore, Brazil, Canada, and Switzerland, that are involved in the digital space to different degrees. We took a slow pathway approach of ring fencing, going from fiat currency into the ETF, and aligning ourselves with Purpose Bitcoin out of Toronto, keeping it very simple concepts, working again with global players like State Street to be able to fast track and deliver that. And we've seen, whether you're agnostic or have a view on does your SAA benchmark need some digital in there? You've got your bonds, different parts of the capital structure, you've got equities, emerging DM, non-listed REITs, commodities, etc. So digital probably fits in there for a few percent. So in an asset allocation framework, but we paraphrasing other people, we see there's digital, and the digital space, there's Bitcoin, there's Ethereum and everything else. And we're staying away from everything else for the foreseeable future. But working on that, we've seen that demand and trying to keep it simple, but many stakeholders globally and keeping to achieve that, but also working with the local regulator to achieve that. And that's for the retail market. And then there's an extension to what Ruth was saying. It's some other themes is the non-listed space. We're engaged in that non-listed VC, PE with family offices. Quite a lot of work's going into that, again, within the region, and just traditional REITs as well. Low gear property assets, they've got CPI hedges. So that's just some things just picking up on that, this extension.
Interesting. Thank you. Neil, you had to come in now.
Yeah, I mean, I'm going to echo the comments of my fellow panelists. ESG is undoubtedly a mega trend, but But I think certainly in Asia, you will find that there is a very wide distribution of knowledge of, incorporation of, and adherence to any form of ESG, what I'm going to say, philosophy underlying the investment process. So I don't see in certain markets in Asia there being a fundamental reappraisal of the investment process to build in ESG principles. I think that happens with many of the global names and maybe 2 or 3 of the more, I'm going to say regional names. But if you go down to some of the smaller asset managers in Hong Kong, Singapore, even in Australia, ESG is not part of how they think about investing. And so I think there's a huge gap between the amount of newspaper columns and inches that are devoted to ESG and the reality of the investment processes that sit behind it. That said, I think it's a positive trend and one that we, as participants in the industry, should be encouraging. Another dollar of capital that's devoted to more sustainable planet is a good dollar. Crypto, digital. I'm interested. I kind of almost see the world in 180 degrees different to Ruby when it comes to crypto. Sorry, Ruby. But I guess to me, as I see the crypto landscape right now, Bitcoin and Ethereum being the 2 kind of poster children here, it's mostly a retail game. Most of the holders of digital coins are retail, and they're holding them through exchanges in personal wallets. Institutions have yet to really, I think, allocate, to George's point, the 1 or 2% of the portfolio that they may well want to allocate to digital assets of all forms, so whether that's crypto, whether that's NFTs, whether it's tokens that represent a claim on a building, whether it's tokens that represent a claim on an artwork. I think we are in the very, very early days of seeing institutions become comfortable with, knowledgeable about, and being able to invest in that type of digital asset. The one thing that neither of you mentioned was solutions. So I think that we are, and I think, Ruby, this talks to something you were talking about earlier about mass customization. I think we are also on the brink of a mass customization wave breaking across the industry. And that will mean that the world of investing that we all grew up in is going to be transformed, certainly on the retail side of the house, to one where I can use my mobile device to instantly reallocate my assets and choose a new asset allocation and have those orders sent automatically and have those orders settled in near real time. Now, because all of the technologies to make that dream a reality exist today. They just don't exist at scale, and they don't exist in unison and in cooperation with each other. And so I think that the world of personal investing will be transformed by technologies over the coming years, and solutions will be part of that. So I will have my own preference for my own personal asset allocation. I'll have my own preference for the stocks I want to exclude from an ESG standpoint. I'll have my own preference for the digital assets I would like to include or otherwise in that portfolio. But I will be able to express that view using very simple, intuitive technologies. And I think that's a huge challenge to how asset management works, frankly, from front to back. I guess topics, products du jour, money market products. As yields increase and go up around the world, I think we're going to see assets travel back into money market funds. So we're seeing a lot of interest from our clients in launching money market funds right now. And obviously inflation protection. So to the extent that it is possible to create portfolios that insulate investors from the negative impacts of inflation, then I can see huge interest developing in that in a world where non-zero inflation looks likely, at least in my mind, to persist for a small number of years. So I would say, just to add to the panel, so I would take ESG, I'm going to take crypto. I would agree with private markets, but I think they've been here for a long time. But I would add money market and inflation protection to the list.
That's great, thank you. And I think a couple of trends that were sort of picked up on there relate to the next topic we're looking to discuss. So Ruby, you mentioned the sort of blurring of the lines between retail and institutional investors, and Neil, you mentioned the sort of automation technologies behind sort of new distribution mechanisms. There is a lot sort of happening in how products and funds and investments are distributed to a range of different institutional and retail investor bases at the moment. So perhaps we could talk a little bit about some of the sort of principal trends that we're seeing there in terms of what's changing and what's likely to be new in the near-term future. George, do you want to pick up on that?
Yeah, it's $1 million question on the distribution side. And ultimately, it's about creating sustainable channels for to meet the distribution on it. As Ruby said, there's that blurring of retail and wholesale on similar risk budget allocation and offering the same themes. But I'll attempt to cover it all. Wholesale distribution is quite unique and the world over, and relationships with pension funds and sovereign funds involved a unique skill of individuals that have been in the industry for some time. And that I would have to flag that is a different type of relationship and channel for seeding various funds, which we've done on ESG and carbon style funds, etc., in this part of the world through pension funds. And that's poles apart effectively from a retail channel distribution team. So, and it's about everything in between. So there's that level of relationship with pension funds that we have in, again, North America, sovereign funds around the world, pension funds in Europe and Australia. And that's a different channel, and it will remain so in my opinion. On the retail, always experimenting and exploring, and have done a lot of that over the decades. And what we've been doing, and again, obviously State Street's part of this journey with us as a key custodian, but we experimented with a specific global growth mandate, a GARP strategy equity fund, but we're experimenting with, it's over $1 billion, so it's quite sizable, but we'll be able to deliver where the custodian is State Street, but able to deliver 3 subclasses and work with that. And the 3 subclasses are wholesale with their wholesale channel, the retail and an ETF subclass, all at the one fee for all subclasses from the RE side of things, and to help with that ETF. So the ETF's the different channel. It's a proxy retail, it's obviously on the exchange, and that attracts an investor at a small or large amount. The retail investor is quite unique and needs a distribution and distribution teams on that retail, no matter what jurisdiction you're in, whether in the UK, Europe, Asia, Australia, North America, and then obviously the wholesale. So I'll start the conversation. There's three ways of doing it. There's the listed component that's a proxy for retail, and that can be listed anywhere in the world, ETFs, active ETFs, for example, or passive enhanced, as Ruby indicated, some funds. There's the retail that's very highly regulated in every jurisdiction, and then there's the wholesale, and trying to find channels to receive FUM in a sustainable way. Again, it's $1 million question, but you've got to try technology and those 3 components.
Brilliant. Neil and Ruby, would you like to add anything to that?
Ladies first, Ruby.
Okay. I'll pick up on George's point around the retail and wholesale, and I'll touch on institutional a little bit as well. So the main words we'll hear is disintermediation of the market when we think about wholesale. Now, how much of that is a reality and in what time period, I think, is the $1 million question for me, because the distributors have such a big presence, they have such scale, which means that the fee and pricing model that they offer is, hugely competitive. And if you see what those distributors are doing, they're looking to form strategic partnerships with asset managers whereby, the sub-advised mandates and the sub-advised channel becomes kind of really profitable. So I think that's the distributor and platform response to this notion of disintermediation. Actually, asset managers, you can't quite get there, so why don't we help you? And we create these component building blocks and sub-advised mandates that give you the flows, but give the market what they need in terms of being able to create the model portfolios. I think if we fast forward, there could be some asset managers that are going to win and create that disintermediated model. And we are seeing and speaking to clients that are very much thinking about that. And that's where digital tokenization, they're really taking that seriously, and they're really looking to lead the charge in terms of not just tokenizing for real asset funds, but in the UK and in Europe, looking at what does tokenization mean in terms of completely changing the fund model and the investment model on its head, such that you can give sort of, fractionalized ownership. You can give access to sort of, any asset pretty much through that tokenized mechanism. So I think you've got the two trends that are almost slightly conflicting, but slightly sort of progressing. And I think the distributors will continue to push hard with their sub-advised mandates. I think the other trend we're seeing is some of the asset managers starting to look at the wealth market as an opportunity in terms of, capturing more of the margin and starting to create that sort of vertical integration model whereby they can, acquire wealth outfit. They have access to that end of the market, but they're also able to leverage their infrastructure for that wealth market and sort of bring the two business models together. I think on the institutional side in Europe, there's still a huge amount of assets that are managed internally. I think something like 40 to 50 trillion, where there's still opportunity in Europe to be looking to acquire that. And I think generally there's a consolidation effect. So where you've got consolidation of asset owners, you're starting to see, larger institutions that have larger buying power and larger influence are going to want to work with fewer asset managers that not only have the right product range, but also the right operating model to engage with them and deliver what they need from a service perspective, from a portfolio modeling perspective, from a data perspective.
Thank you very much. Neil?
Nothing really left to say. I've two great panelists that just given you the best answer you could possibly have, James. Insta's not going to change too much, I don't think, and retail is really where the action's going to be when it comes to distribution.
Okay, and short and sweet.
And just add, if I may, just reinforce that retail is highly regulated in all jurisdictions, and just to reinforce that point. And so that's the importance of a sustainable strategy for retail, and anyone getting involved with it, you've got to be very cognizant of the guidance you're giving in that market relative to the jurisdiction that does not like too much forecasting or guidance, for that lack of a better term, or staying away from expected returns, because they're not going to understand expected returns, risk budget allocation, etc. But be very cognizant that that's a highly regulated market, and they deserve some sustainable solutions to be able to match, again, as Ruby and Neil has mentioned in other asset classes, they need to match wholesale sort of style funds, but be very careful in the market. So the margins look compelling for new entrants, but they generally would fail without that 3-year view of investing and having, again, overusing a word, a sustainable strategy to within that retail network.
Yeah, absolutely. And the sort of the arc of retail regulation certainly is always sort of in the direction of consumer protection, and that's something to consider. I think one thing that's interesting, perhaps not surprising.
I think the interesting point, James, sorry, I think one of the interesting points here, and I think Ruby was picking up on this, is some brands, and a small handful of brands I think are genuine, like an investment brand, they will go direct to consumer. They'll be able to afford the technology that takes them right to the end investor with nobody in between. And you're already seeing some experimentation with that. But I think that's only open to a small number of players who have genuine investment brand and can afford the technology. I think most other asset managers will continue to pursue an intermediated model, and that may change and reshape through time. And to Ruby's point, maybe sub-advisory is a way to capture some of those flows, and maybe tying up with having a platform strategy that says you tie up with a small number of platforms on a more dedicated basis that allows you to be promoted on that platform more regularly than maybe you might otherwise choose to be. But I think that the notion that the value chain or the buying chain as currently expressed between I desire this investment and how I buy it, that will completely change over the next 5 years. In most markets, even if they're regulated. Yeah,
definitely. And I mean, somebody still has to have a platform from which to buy the investment, whether it's a stock or a fund. So the question is whether the intermediary is a traditional financial services one or a technology company which has created a better a better interface for making that transaction, I guess. Which does bring me on sort of neatly to the final question, which is that technology has, or emerging technology has basically been something that every single one of these topics we've discussed so far has sort of boiled down to. And we've talked a lot about digital technology, largely in terms of sort of, you know, currencies and Bitcoin and things like that. But Ruby also touched on the ability for these technologies to bring illiquid assets to retail investors, and to enhance the ability of investors to even buy sort of traditional liquid list. Go into in a little bit more detail, and also some of the technologies like artificial intelligence and process automation that are making asset management processes, distribution, and also in the sort of back and middle office more efficient in terms of operations, and sort of lowering costs and making investments more accessible through that way. So perhaps if we start with the tokenization question, Ruby, I know you already picked up on it, and how that can be a mechanism for getting traditional or sort of existing asset classes to a wider range of investors.
Yeah, so I think we're seeing, I mentioned there's quite a lot of focus on the blockchain fund regime. There's quite a lot of, I guess, working with the regulators to understand what needs to be put in place as some of these asset managers look to launch tokenized funds in the real asset space. I think there's two ways tokenization is being thought about. The first is in terms of giving access to the real assets world for the more sort of retail end of the market. And I think there's still a fair bit of work that needs to happen before the regulators, certainly in the UK, are comfortable with things around the liquidity positioning. You know, how much does tokenization actually address some of the liquidity challenges of the illiquid market? Where, you know, hypothetically, there's this notion you've got a secondary market to sort of trade the token. So I think there's a lot of working through the mechanics of that for the regulator to be comfortable before we're actually launching that. And if we see the focus on consumer duty, assessment of value, etc., that focus on what you're marketing to the retail investor and how it's actually happening, how it's actually helping them, I think all of that needs to be thought through. So I think we're probably still a year or two away from funds being launched into the retail segment of the market. Tokenization more broadly and the digital issuance, I think, is a longer trend that needs to be thought through. So I mentioned the Investment Association in the UK are working with a number of asset managers to flush out what does, we call it, an investment 3.0 model look like. Whereby it's not tokenization of assets, it's a tokenized infrastructure that supports the market. And so there's working groups and work that's actively taking place to think through how does that actually work. Now that, as is with blockchain, requires multiple participants in the ecosystem, in the value chain, coming together to make that work. So that's the asset managers, that's the asset services and custodians like State Street. That's the regulator, that's the depository, you know, all parties need to come together to make that work. And that's the thing that's tended to be a challenge, I think, in the asset management industry, is to move forward that collaboration effect and participation to say, is that the right model for the future for the end investor? And if so, how do we make it a reality? And how does everyone look to change their operating model to enable that?
Absolutely, that's extremely interesting. George, do you have a perspective on that?
No, the other thing I can add was a bit slightly different, where we're looking at ways, obviously, from a sustainable distribution to use technology. But one area that's actually been working with us quite successfully, been developing over 7 years now, and has now been rolled out to clients and consultants is, this is a bit specific, but one of our investment teams has got lots of data, over 20,000 stocks, and it's using AI, a bit of machine learning, to assist with at different stages of the business cycle what type of stocks have historically these different PMs have put in their shortlist and invested in. So I've been using that tool. So part of their weekly meetings is when they go through their qualitative, quantitative process on their respective sectors on a global scale, they've now incorporated the shortlist that the AI or the bot is replicating that portfolio manager. And we're finding it quite interesting. and it's got quite a high correlation with what they normally would have done at the meeting with that shortlist. So we're using that as you'd expect people to use with AI, machine learning availability, and the code's becoming more accessible. So our people are accessing and getting access to code that is much cheaper today than would have been 3 years ago, and let alone 5 years ago as well. So I'm just adding that, and that we're finding the consultants and the pension funds in particular doing deep dives into that, and they're quite interested because we're not the only fund manager. That's also engaging in that and experimenting with it, but now it's part of the investment process.
That's very interesting. Thank you. Neil, we only have a few minutes left, and I appreciate there's quite a sort of broad spectrum of technologies sort of involved in this question. But in terms of your client conversations, what are you hearing about most? What are they most interested in discussing on the emerging technology side of things?
Yeah, I think it depends who your audience is, James. So if you're talking to a CIO or a portfolio manager, someone involved in the front office, they're obviously very interested in the ability of machines to intelligently process the vast amount of information that is now available to every portfolio manager every morning. In fact, 24/7, 365. So when I think about the poor portfolio manager, she's running a portfolio every day. If I think about just the sheer terabytes worth of information that's available for every stock in the current universe in the portfolio, and just the universe of potential buys outside of that, you need something which is highly intelligent and performant to synthesize that information to help that portfolio manager develop her investment thesis about a stock. That's hugely transformative. And also very difficult to do and pretty expensive. So I think that the ability of in computing more broadly to implement investment theses into a universe of information, which is constantly expanding, is just becoming more and more difficult, becoming more and more of a technology arms race in the front office. And I pity the poor portfolio managers who have to try and keep up with this. And then if I think about the trading infrastructure, so middle office, so once the portfolio manager, once she's decided what stock she wants to hold and in what proportion, how is technology helping implement that view into the marketplace? Well, obviously, we as State Street, we sit behind some of that. And we use AI, I guess, and machine learning in various ways. So I think one of the coolest applications I've heard of is in fund accounting. So traditionally what we've done with fund accountants is to essentially associate the returns of a fund with a benchmark. And we use our human experience to do that. So typically, over time, we'll learn the portfolio and we'll associate a benchmark with it. Now, it may not be perfect, but it actually makes our job a bit easier when it comes to identifying any exceptional days and exceptional moves in the portfolio that trigger a deeper level of review. Well, we built a piece of AI in the US, which essentially means that we pick the perfect benchmark for that fund based on all available benchmarks for the last 20, 30 years. Then the machine runs the benchmark against the fund and alerts the fund accountant where there are exceptions. Now, traditionally, a fund accountant may find an exception once a month. The application of this software means that we don't have to do anywhere near as many checks as that. Now, the benefit of that comes back to the fund manager in that we can pay back that efficiency dividend by lowering the price at which we do fund accounting. So changes in the front office, changes in the middle office, I think changes in terms of how front ends work, how sales work. So a more intelligent sales system that says the last time we had this type of regime change in interest rates, this is what these 10 advisors did. This is the funds they bought. And the ability to get inside that decision loop and arm your sales folks with the information to call those advisors and say, we recognize the last time the Fed raised rates by 75 basis points, you changed your asset allocation in this way, and you bought these funds. We'd like to offer you these funds from our platform. So I think that there is intelligence being applied across the entire value chain from portfolio management through, if you like, trading and trade lifecycle management through to how you deal with clients at the front end, which will ultimately ultimately land us in a place where we have a much more better informed portfolio manager. We have better, therefore, more resilient portfolios. We have better informed consumers of those portfolios, so a better tie-up between investor need and the portfolio, and a much less costly information system, transaction processing system in the middle.
That's excellent. That brings us very close to time, but Ruby and George, is there anything you'd like to say in response to what Neil's just said?
I think I just reinforce. Yeah, I think I just reinforce. I think Neil beautifully articulated what we've seen today is naturally a lot of innovation and use of technology in the front office. In terms of quantum computing is the next trend as well, in terms of what that can do for portfolio optimization. I think the asset managers that are now starting to look at where else in the enterprise can they take that use of technology and innovation right through the operating model, that's where they're going to be most successful, because I think there's still a lot of space to win in the core operating engine, if you like, of the asset manager that still hasn't been tapped into. You know, it's still experiencing siloed pockets of automation. So I think more of a scale effect of emerging technology in that space, plus the distribution side of the business, which Neil alluded to, you've then got what is, you know, the kind of nirvana, which is a data-driven asset manager that's using data in sort of all of their processes and the way that they preempt what the investor's going to want.
Thank you very much. George, anything to add?
Yes, spot on with what Ruby and Neil said. And the only thing to add to all of that, because we're using it again in our investment team process, but looking at other areas, it's not, don't think of it as a replacement of your job. For those that ask that question, think of it as it complements. It just means that the sector going forward in the decade ahead won't employ as many people as otherwise if it wasn't for the machine learning and AI, but it's there to complement, and it's still job growth within the financial services industry in all areas is still going to be increasing, and there'll be demand for that. So just putting that on the record when people ask that.
Excellent. Well, thank you very much, all of you. That does bring us to time. For those of you listening, I hope you've enjoyed this, and apologies that we didn't get round to questions here, but as I said before, we will follow up with you if you put them into the Q&A box. So yeah, it just reminds me to say again, thank you very much to my panelists, and we hope you've enjoyed this and found it useful and interesting. Goodbye.
Thanks, James. Thanks, George. Thanks, Ruby.
James. Thank you.
Thank you all. Cheers.